What if I told you that 10 years ago, two investors each started with just $10,000, but one ended up with about $41,000, while the other grew their money to over $230,000, without adding a single extra dollar using leverage or trading meme stocks? The difference wasn't luck, it was simply choosing a different ETF. But here's the part most people miss. The goal isn't to chase the next miracle investment. The real secret to building wealth is earning just a little more than the market over a very long time. Even a few extra percentage points each year can completely change your financial future thanks to compounding. That's why many smart investors keep VOO or VTI as the core of their portfolio and add a small position in higher growth ETFs. One option is VOOG, which focuses on the fastest growing companies in the S&P 500 like Microsoft, Apple, Nvidia, and Alphabet. Then there's QQQM, a lower cost version of QQQ, packed with the biggest technology leaders that have historically outperformed the broader market. If you're looking for something more dynamic, SPMO follows the strongest momentum stocks in the S&P 500, constantly rotating into market leaders. And for aggressive investors, SMH focuses on semiconductor companies like Nvidia, TSMC, AMD, and Broadcom, the businesses powering AI, cloud computing, and the future of technology. Historically, these ETFs have delivered stronger returns than the S&P 500, but they also come with much bigger swings. That's the trade-off. Higher potential rewards always come with higher risk. The smartest strategy isn't replacing your core index fund. It's using one of these as a small addition to your portfolio, staying invested through market volatility, and giving your money years to compound. Remember, wealth isn't built by chasing hype. It's built by owning great businesses, staying patient, and letting time do the heavy lifting. If you want your portfolio to work harder without abandoning proven investing principles, these ETFs are worth researching.